Today is the start of a new tax year. It's going to be an interesting one. There's lots of changes taking place in the tax system. So let's start by setting the scene. You're at the start of a new tax year. There's lots of changes that have taken place. There's more changes still to come. What decisions do you need to make? What changes have you got to put in place? What strategies do you need to adopt to get your tax right? With 365 days ahead of you in this tax year, I want to give you 7 tips to make you tax fit for the new tax year, for 2016-17. The first hot topic is dividends. We've spoken about this before, and if you pay yourself a dividend from your own company, then it's inevitable you're going to pay more tax in the future. But if you pay your spouse or other family member, then the first £5,000 of dividends that each of them receives is only taxed at 0%, no matter what their marginal rate of tax. So could this be a good time to transfer some shares? Next, incorporation relief. Now this certainly isn't new, but it's been given a new importance because of the changes which are coming up from the 6th of April 2017 in the deduction of loan interest for individuals with residential property portfolios. Companies are exempt from these new rules. What we are therefore seeing is a lot of people with residential property portfolios, particularly where there's a lot of interest to be deducted, are looking at incorporating their businesses. Incorporation relief enables you to transfer properties into the company, and any capital gain is rolled over into the shares. The properties themselves are transferred at market value, and this is what is used to calculate any subsequent gains. Now, there are some very interesting allowances out there at the moment. There's your personal allowance, there's the employment allowance, there's a starter rate for savings, there's a savings allowance. What I'm going to say will not be applicable to everybody, but if you were to pay yourself a salary of £11,000, the employer's national insurance will be covered by the employment allowance. If you can pay interest from your company of £5,000, this will be covered by the starter rates for savers. You could then pay an additional £1,000 to use the new savings allowance. Potentially, the company has received tax relief on £17,000, and you've received £17,000 tax-free. Returning to dividends, if you receive more than £5,000 of dividends from your investments, then one way of sheltering the dividends from the new dividend tax is to transfer your investments into an ISA so that the dividends are tax-free. The higher rate dividend tax is now 32.5%, and the Chancellor has taken the opportunity to increase the tax charge on overdrawn directors' loan accounts for all new advances after the 5th of April 2016. Now, a big change which has taken place from the 1st of April 2016 is the reduction in the relief for rates on business property which is empty. And this will affect both industrial and commercial premises. And it's been suggested that this is likely to result in a lot of older properties which are presently standing empty being demolished, and also be a disincentive to speculative building of industrial or commercial premises. Finally, don't forget about the potential for transferring 10% of your personal allowance where neither of you are higher rate taxpayers. This doesn't amount to a great deal of tax saving, but as they say, every little helps. The maximum personal allowance that you can transfer is £1,100, and as this will be taxed at 20%, the tax saving is £220. To make a claim, you can either go online, and you'll see the link on the screen just now, or you can phone HMRC. So, big changes in the tax system for 2017, some more big changes that we know about already for 2018, and so I think we're going to be in for a very interesting time. This is Alan Long from the Long Partnership, making life less taxing.